G'day folks, welcome back to another update for the S&P 500 and NASDAQ. Now they're both pushing against resistance, but we are seeing a likely pullback in the near term, a possible retrace. So I'll go through those in a minute, plus some back testing. Also, don't forget to hit that like and subscribe button to support the channel, but also reference the +1 videos to get a deeper dive into analysis and some of the trading strategies that we use in these videos. In terms of the outlook, the key takeaways, the S&P 500 is broadly bullish. Most forecasts see continued upside with midterm targets ranging from 6,900 to about 9,000 by 2026 and 2027. Key drivers are AI momentum, potential Fed rate cuts and strong second quarter earnings, though elevated valuations and inflation risks temper enthusiasm. For the NASDAQ, still driven by AI and big tech, particularly the Magnificent Seven, analysts expect further gains around 15 to 20% in the near term, but concerns about valuation excess waning against analyst optimism introduced downside risk. So first looking at the S&P 500, so we've got here the weekly, the daily and the hourly. We always look at the long-term trends, and on the weekly you can see here the price is still above the moving average band, and these moving averages, for those new to the channel, are in the description below if you want to learn how to draw those. And the reason I've got multiple moving averages is I like to see the bands widen as the price increases, like it was here. Down here the CCI was already widened, and if you notice here, for example, when the band started to constrict, that shows a bit of consolidation possibly happening, especially on the price range. Let's try and find, it's not going to show me anything now, but you can see there that the price was constricting, and then obviously then eventually there was a reversal. But sometimes you get a more exaggerated constriction like it was here on the CCI, so just be mindful of that. But on the daily, so the weekly is bullish, but pulling back, as you can see, we had a bearish divergence here. Lower highs on the CCI versus higher highs on the price. That hasn't actually started to come back yet, so as soon as that starts pulling back, we'll telescope a potential target range for that. But at the moment, somewhat still cautiously bullish on the weekly if you're trading on the daily. On the daily chart, you can see there the CCI starting to drop off. We did have a longer term bearish divergence here versus the price, and again hasn't really started to pull back yet. But the CCI is showing weakness, and that's already starting to pull back on the CCI. And so somewhat neutral positioning, if anything, I'd call it bearish at the moment. It's coming back below those moving averages on the daily. So I would avoid going along at this point. On the hourly, we look for any micro moves. So even if you're trading on the daily, we'll look at any micro moves on the 1 hour time frame to see if there's any negativity, if you like. Back here we had a bearish divergence, lower highs on the CCI versus higher highs on the price. We drew a target range for that, and that was a 23-38% range. You can see there that 23-38% range, it came through, went as far as a 50%, then it bounced. And what we have now, if you look here as well, there's no divergence currently there in that little range, but if you zoom out a bit, you'll notice we had a wider bearish divergence there between the same range. That's a bearish divergence as well, and what that looks like, very, very similar to that one there. If we draw Fibonacci back to that low before the divergence started, you can see there it's already hit that 23 minimum range, the 23-38% range. That also has come down to the 50% range as well. So again, it had a bit of a bounce so far on the hourly, but again, notice the price and the CCI is pulling back into that moving average range. So I wouldn't be going long at this point. I'd like to see the daily, if I was trading on the hourly, I'd like to see the daily stretch higher above the moving averages on both the CCI and the price. So let's look at the back test. So what I've done here on the daily, you can see there I've got a arrow where you would have gone long theoretically back at that point when the price broke above the moving average band, but also the CCI was above. And what you do is you run the hourly in this case. You can run other time frames, but I'm looking at the hourly primarily, but it applies to almost any other time frame, intraday. You let it run, and basically the strategy here is whenever you see the CCI in an uptrend, as well as the CCI as well as the price, you wait for a break to the upside on the CCI 14 here to take an entry. This is one strategy. There's plenty of strategies you can apply here. So had you let it run through that period from back there till today, you would have been up about $34,500 with the exception of that little drawdown there. That was a significant drawdown actually. And the way you avoid that drawdown is you look for any micro moves, as I said, any bearish divergence. There you had a double top on the CCI versus slightly higher highs on the price. That eventually pulled. You would have got out of it at the very latest if you're going long at that point there before that drawdown started. You can see there's all spattering of bearish divergence throughout that whole period against the price and the CCI. And at each of those points, you would have got out of any long positions. So trading the daily direction, but also watching for any divergence on the 1 hour time frame. So the NASDAQ has a similar sort of pattern. On the weekly, first off, the price is above the moving averages. Notice the CCI has already broken into that moving average range, so I'd avoid going long if you're trading on the daily. You want to trade in the direction of the higher time frame. So here we've got a bearish divergence, lower highs in the CCI versus higher highs in the price. On the day, now I will draw a target range for that. So let's go back to the Fibonacci on this. Let me just expand that. So going from that high, we take it back to this significant low. You could take it there as an earlier point. That's the low before that divergence started. But let's take it back to that level. Be a bit more challenging. We draw a Fibonacci range or target range between that 23 and 38% range. That's a minimum, and that coincides with those moving averages there as well. So if the price starts pulling back from there and the CCI continues on a downtrend, we expect it to hit that as a minimum. It could just touch that and then bounce, or it could go right into that range and consolidate, or fall right through. We don't really know what's going to happen, but that's a minimum touch point. It could, and that more than 90% of the time it hits these 23, 38% ranges. So that's the weekly. On the daily, we've also got a declining CCI below the moving averages, and so is the price. So that's already in a bearish momentum. And that was after this. We had a long-term bearish divergence. You can see there. That could have been drawn up to that point there. And again, what I've done here as well, previously in previous videos, I've highlighted previous bearish divergence, lower highs on the CCI versus higher highs on the price, and each one of those points pulled back to a decline. And that's theoretically where we are now, pretty much a double top or a triple top on the CCI versus higher highs on the price. And if we were to draw a target range on that, go from that high down to that low. Let's just draw that target range now to that 23-38% range. That's a minimum. We can expect it to fall. Could go a lot further, of course. We don't know. But that's the daily minimum range. Now, of course, this could keep rising and go further up. And if it does that, we expect then the divergence to be invalidated. But at the moment, because the price is broken below that moving average range, we expect it to continue on a downtrend at this point in the short term. And on the 1 hour time frame, what we're looking for is any divergence. So we're just working backwards, zooming out. You can see there that CCI is moving in tangent with that price. So there's no divergence there. Going back to this point, that also was lower highs, and that was lower highs. So there's no divergence there. Now, so there's no divergence to worry about on the 1 hour time frame. Let's look at the back test. So again, going to the daily first off, you would have taken long trades along that period there, and you would have closed it out each time the CCI broke into that moving average range. So the first time you would have closed it out was at that point there when the CCI on the daily broke into that moving average range, and that would have been near the high there of that little price range. You'll notice here on the right hand side on the 1 hour time frame, that also coincided with this bearish divergence. So you would have got out of that little trade there, and at that point it was generating about $1,600 in revenue. Again, follow the hourly trade strategy, but again, getting out at each time whenever the daily breaks below the moving average range or into that moving average range at each of those points. At the moment, because it's consolidating and turning into a bearish momentum, avoid going long. But had you stayed in the whole period, just to demonstrate how that strategy works, it generated about $6,500. But obviously at each of those points, you want to avoid any drawdowns. Make sure you hit that like and subscribe button to support the channel, but also reference the Patreon page where we look at weekly bullish shares, where we cover each week of various markets around the world. Thanks for watching, and see you in our next update.